We'll discuss the difference between ETFs and hedge funds and cover everything from treasury inflation-protected securities to derivatives such as options, futures, and swaps, with this brief introduction to assets and financial instruments to provide a general picture. Assets with similar attributes and governed by shared laws and regulations are often categorized as an asset class. The most widely known classes are equities, fixed income and cash equivalents, alternative investments, commodities, and currencies. Investing in different asset classes, which tend to have low correlation, usually results in a more diversified portfolio. Let's start with equities. First on the list are stocks. When you buy common stocks, you basically acquire a share in the ownership of a company that may increase in value over time and pay dividends from its earnings. Preferred stocks, on the other hand, differ from common stocks in that they usually don't offer voting rights in corporate matters, but often offer a higher dividend payout. Typically, preferred stockholders are entitled to receive fixed dividends at regular intervals, and these dividends are paid out before dividends are distributed to common stockholders. When bundling different stocks or other assets together, a fund is created. An index fund passively tracks the performance of a specific market index. This means you can own a number of different shares without having to buy them individually, which generally lowers transaction costs. The return is based on all underlying assets. Mutual funds are actively managed vehicles that pool money from a large number of people to invest in a variety of stocks, bonds, or other assets, while trying to outperform the market. It should be mentioned, though, that the costs of actively managed funds are typically higher than those of passive ones. Exchange-traded funds, or ETFs, are similar to index funds but can be traded throughout the day like stocks, while index funds can only be bought and sold at the end of the trading day. Passive funds can be more tax-efficient due to their unique structure. Also, since they only replicate the holdings of an index, they don't trade in and out of securities as often as an active fund would, generally resulting in lower taxation. A life cycle fund adjusts its asset allocation over time to match your age and retirement goals. When you're younger and time is on your side, these funds tend to invest more aggressively and are therefore riskier, but have the potential for higher returns. Over time, the allocation shifts to a lower risk portfolio with fewer stocks and more bonds to protect your money for retirement. They can be a convenient hands-off approach to investing. Also interesting, only 5% of people who watch my videos are actually subscribed. So if you are included in the 95% of viewers who aren't subscribed yet, go ahead and reverse those numbers. It's completely free and helps out a ton. Lastly, feed a like to the algorithm. The value of derivatives is derived from the performance of the underlying asset. Options, for example, are contracts that provide the holder with the right to buy or sell an underlying asset, like stocks, at a predetermined price, known as the strike price, in the future or during a specified period of time, and offer the possibility of profiting from price movements. The execution of an option is not obligatory for the buyer of an option. If the price of the underlying asset rises above the strike price, the call option, which gives you the right to buy, can be profitable. For a put option, granting you the right to sell, it's exactly the opposite. Futures, on the other hand, are contracts that obligate the buyer to buy or sell an underlying asset at a specified price in the future, and also provide the opportunity to profit from price movements. Futures are typically used to hedge the price movement of an underlying asset to help prevent losses from unfavorable price changes. Mining companies, for example, often use future contracts to hedge against price fluctuations. By selling futures, they can lock in prices for their future production. Forward contracts are private agreements between two parties to buy or sell an asset at a specific price and date in the future. They provide more flexibility in terms of customization compared to futures, which are more standardized and regulated. By leveraging, you basically borrow money to increase the potential size of an investment position with the aim of magnifying gains if the investment performs well. This is a double-edged sword, though, as losses are also magnified. If you buy stocks with 5 times leverage and they increase in value by 20%, you made a profit of 100%. However, if the stock declines by 20%, the position will be closed automatically, and 100% of your invested money will be lost. Swaps are financial agreements to exchange cash flows based on different financial instruments or variables. They are often used for hedging or speculation purposes and allow parties to manage risk and potentially benefit from differences in market conditions. Currency swaps, for example, involve the exchange of principal and interest payments in different currencies. The parties agree to swap currencies and repay the principal at a specified future date. Currency swaps are commonly used to manage foreign exchange rate risk or obtain financing in a different currency. Rights and warrants are financial instruments that give the holder the option, but not the obligation, to buy or sell an underlying asset at a specified price and within a specified time frame. Rights are typically issued to existing shareholders, allowing them to purchase additional shares of the company at a discounted price. Warrants are similar but are usually issued to investors as a sweetener alongside a bond or preferred stock issuance. Cash equivalents and fixed income assets are considered low-risk investments that provide a safe haven for cash holdings. Bonds are debt securities issued by companies or governments that pay regular interest income to investors. When an investor purchases a bond, they are essentially lending money to the issuer for a specified period, during which the issuer promises to make regular interest payments, called coupon payments, and return the principal amount known as face or par value to the investor at maturity. They trade heavily at times when the Federal Reserve, or other central banks, raise interest rates. Treasury or T-bills are short-term debt securities issued by the U.S. Treasury Department. They typically have a maturity of 1 year or less and are considered one of the safest investments. Investors purchase T-bills at a discount and receive the full value of the security when it matures. Treasury inflation-protected securities are bonds designed to preserve the purchasing power of investors' principal and interest payments in the face of inflation. The principal value of TIPS adjusts based on changes in the Consumer Price Index, which measures inflation. Convertible securities can be converted into other types of assets, such as stocks or bonds, at a predetermined price and time, providing investors with the opportunity to benefit from changes in the price of the underlying security, while also receiving interest payments or other income in the meantime. Mortgage-backed securities are financial instruments that represent an ownership interest in a pool of mortgage loans. They are created when financial institutions bundle individual mortgage loans together and sell them as a package to investors. These securities are backed by the cash flows generated from the principal and interest payments made by borrowers on the underlying mortgage loans. Asset-backed securities, on the other hand, represent an ownership interest in a pool of underlying assets. These assets can include various types of loans or receivables. These securities are structured similarly to mortgage-backed securities, but instead of being backed by mortgage loans, they are backed by a diverse range of assets. A certificate of deposit is a type of savings account offered by banks and credit unions that typically offer higher interest rates than traditional savings accounts, in exchange for the account holder agreeing to keep the money deposited for a set period of time. Commercial papers are unsecured short-term debt instruments issued by corporations, banks, and other financial institutions to meet short-term funding requirements. CPs are usually issued at a discount, and the investor earns a return by holding it until maturity. Money market accounts invest in low-risk, short-term debt securities, such as treasury bills and commercial paper, providing potential for income and liquidity. Annuities are contracts designed to provide a steady income stream during retirement or a specific period. They are typically offered by insurance companies and can be purchased through a lump sum payment or regular contributions. Annuities can offer a lifelong guaranteed passive income. Retirement accounts like 401k plans or Roth IRAs are designed to help individuals save and invest for retirement, providing tax advantages and long-term growth potential. While a 401k is employer subsidized, the advantage of a Roth IRA is that contributions are made with after-tax income. Therefore, withdrawals in retirement are tax-free, including investment gains. Next, we are discussing alternative investments in real estate. First, we got rental properties like residential or office buildings that are owned by an investor and rented out to tenants in exchange for regular rental income. Agricultural and forested land also falls into this asset class. Farming can generate income, while the land may increase in value over time. Alternatively, plots can be leased to third parties or given to them for use in return for a ground rent. Hedge funds are typically open to a limited number of investors and invest in a diverse range of assets and strategies, with the goal of generating high returns and minimizing risk through various hedging techniques such as previously mentioned derivatives and short selling to mitigate downside risk. Real estate investment trusts are somewhere between stocks and real estate. By investing in a REIT, you're basically buying shares of a company that invests in real estate and generate income from rental properties, with the potential for capital appreciation and dividends from rental income. This allows to invest in real estate with small sums, while the REIT takes care of the property management. Art, antiques, and collectibles. What they have in common is that they are highly valued by collectors. Due to their limited number and uniqueness, they have the potential to increase in value over time, but don't generate cash flow themselves. Let's now have a look at commodities. Commodities in the narrower sense are raw materials or agricultural products that can be traded on markets, offering potential for profit from price movements. An increase in demand, a decrease in supply as well as inflation usually leads to higher prices. Precious metals like gold, silver, or platinum can be traded on markets and are often used as a hedge against inflation and currency fluctuations. They are considered a store of value and a potential safe haven during economic uncertainties. The next category of assets are currencies. Trading foreign exchange involves buying one currency and simultaneously selling another. If you buy euros for your dollars and the value of the euro appreciates, when you exchange it back, you will receive more dollars than you originally invested and thus make a profit. By exchanging traditional currencies, so-called fiat currencies, for cryptocurrencies, you speculate on the increasing value of the latter, with the difference of being invested in a digital asset. Most of the instruments and assets we discussed so far have countless subcategories. Nevertheless, I hope you've learned something new and gained some insights. And if you're now wondering what to watch next, have a look at this video on screen I handpicked for you. Anyway, thanks for watching. Like and subscribe.